Good morning, traders and investors around the world. Welcome to this Monday, January 9th edition of Pre-Market Prep with StockOdds. Hi, Rob Friesen on update in the markets here. S&P 500 index futures are trading up 39 and a quarter handles, 54.75. That's right off the highs of the session. We have the buck down under 103, down 79 cents at 102.86. That's a new low for the move. Bonds down a half point, 128, 24.32. Crude up nearly $2, but off its highs for the session. That's up $1.96, 75.73. Gold working its way towards 1800, up 10.10 at 1879.80. Silver over 24, up a nickel at 24.04. And Bitcoin having a little bit of a rally, up $365, 7,250. S&P futures just take another leg higher here. New highs for the session, Rob. Good morning. And
good morning.
How was your weekend?
Good. Thank you very much. So you put out the topic, does the market have legs? Or
does the rally have legs? Yes. Does the rally have legs?
Well, what do you think?
I think we're in an area of very limited daily resistance. I think you have a CPI number that's coming out on Friday, and people are probably leaning long into the number. 13-day consolidation period resolved to the upside. First day of a 2-day move. You can tell what I'm thinking.
Yeah, that continuation is definitely part of it. It's often that you do go with breakouts anyway. Like a 10-day breakout is more valuable than a 5-day. So we even had a little bit longer than that. So the normal theme would be to respect and go with a breakout. There are times where there's a false start to that, of course. But the market was looking for something to say, can we recommit? Can we get 2022 behind us and start to put money back into the market? There was a lot of outflows, even up to last week, still in the money market. I mean, in the main funds and stuff, there were still outflows. So we saw a change there on Friday with a catalyst. So again, there's this, does the market move on nothing? Sometimes it does. Does it move on a catalyst? Sometimes. And when it does, you have to say, well, what's behind it? What's the reason? So just to summarize, the information we got from the jobs number on Friday was that the Fed's actions are working. Well, that'll either be confirmed by the CPI on Thursday or not, right? If it's confirmed, we're just probably going to have that extra boost. And as we move into mid-month seasonality on Friday, it starts on Friday, and that lasts right till the following Friday, which is expiration. That's supposed to be the most bullish time of January anyway. So we put this proposal out already in December. We said it's possible that we get a good bump in January. And part of the reason is there's again a fundamental reason for things, and that is with the 30-day wash rule, and we saw a lot of tax loss selling. Right, actually, we saw it right up to December 28th, right? And then there was a change on the 29th and 30th already because the tax loss selling implication was done. So we got that, oh, the sellers are not there. So we bounced a little bit, right? So if people are going to rebuy, they're going to start to bump up these stocks that have been beaten down, and that impacts the market because it's not like there's no correlation between some of these big mega caps that have been beat down and the indexes, right? There's a correlation. So just keep that in mind, that there's often a reason why seasonality does work, why certain sectors work. And right now with gold and silver, it's the US dollar, right? Joel, you can pull up the US dollar on your chart again
Yep.
there. And just look at, so Thursday, we had an up move in the dollar and gold retraced. And so the metals are the most impacted by that, right? So gold retraced, silver retraced. And then Friday, the dollar dropped precipitously on the jobs number. And look at what gold did and look at what silver did on Friday, right? And then today, coming into, the follow through from Friday, we see the dollar falling again significantly. And so what's gold doing?
To the moon,
Right.
Alice.
Well, I mean, this is what we talked about this so many times last year and said, get ready for when that, what would you call it?
Turn.
That massive sentiment towards the dollar. I mean, a very crowded trade, a very defensive posture. And as rates were going up, one of the safest places to get returns was parking it into the US dollar. And then, of course, now other countries are raising rates too. So, that changes the equation a little bit for foreign investors. But, the dollar was a great place to park if, you didn't know what else to put it in. And every time you buy any tech stocks, they seem to go down again. So let's put it in the US dollar. So it became a very crowded trade. And we were watching for, when does it start to break and retrace? Because this is going to lift some of these commodities, specifically metals. So it's not rocket science. Like, this is relationships, right? And some of them are inverse relationships. So when the dollar falls, metals usually rise. And it can impact oil as well, but we have other sort of competing factors in oil. I think that China, opening up and sort of stimulus that's going on, and you can see it in first the Chinese stocks, how well they've performed already this year. And so that could mean that the economy does get back on track, which would then be consuming more oil. So, I still think that the oil trade is not like over and done. I think we're going to have a second life to that one. And I don't know at what point it comes, but the declining dollar should help that. So, but first in the metals, they're more inversely correlated to the dollar. So that's that theme. So I'm going to talk about another theme here, and that is we're getting a nice move on Friday from open to close. We are seeing a bit of a continuation of that. We did have a gap, and then open to close, we still might have another good day of performance. So what if I told you? What if I said that? Let's say that over the last 30 years, that the SPY moved up a total of, say, $355 over the last 30 years. Okay. So let's just say that that's how much it moved. That's how much it changed. And what if I told you that all of the returns for that period of time from open to close was minus $10?
I've heard this argument before. It's not an argument, it's statistics. Yeah.
Right, it's statistics. So there's this is the difference between E-minis traders that really think about the global markets and what's happening, and people that only focus on, say, a time frame of open to close, which there's a lot more noise and a lot more mean reverting that happens. So that's why it's so important to respect, when you're trading open to close, you have to respect those days where there's an engine, where there's a catalyst. I've seen too many traders harmed by having an opinion on, say, the spider during the day, and they'll just do some scale selling and something and short it all the way up, and they of course get hurt. And the same thing on the down days, they don't recognize the catalyst and they buy it all day and they get hurt. So I've seen a lot of samples of that, and so generally it's tied to, there's an engine, there's some kind of a catalyst, some kind of a real change that drives that intraday performance on those days, right? But the rest of the time, there's a tremendous amount of noise. So that's why it's very important to separate noise-based strategies and noise trading from, directional implications from days where you could really get run over doing that. And it takes some effort, but you have to recognize the difference. Like on Friday, we opened up, we pulled back, we filled the gap for most markets. The diamonds and the Russell didn't completely fill the gap. The IWM didn't completely fill the gap, but Q's more than filled the gap, and SPY filled the gap. And then it returned to its journey of going up, and it went up all day. And the signal to noise ratio improved as we went higher, right? So it took the NASDAQ, interesting concept, that the NASDAQ was more reluctant and more hesitant to follow along. And it wasn't until about 1 p.m. Eastern time that it started to settle into really high signal, and it was just climbing the upper Bollinger Band. And so it was like, finally, okay, we give up, we'll participate too. We have a little bit more confidence now, but the NASDAQ was more reluctant, wouldn't you say?
Yeah.
On
Yep.
Friday's trade, right?
Yep.
And so these are different markets, they're all different. I mean, the Dow's price weighted, SPY is market cap weighted. You've got, and it's affected by the large caps, but still a much broader index than the NASDAQ 100, which has no financials in it, for example. So you have to understand the different markets, and there's a way to work at playing them against each other and using them strategically. So this concept of the fact that in 30 years there is no performance in the SPY that's come from open to close. None of the performances come from that. So in the big picture, it's all noise. In the big picture, it's very mean reverting, right? So we would be expecting that you can use that in formation of strategies, right? It's a very different posture than an E-minis trader that has to be aware of all the global markets and what's happening in China and what's happening in Europe. And that doesn't mean that the intraday open to close trader doesn't have to also be aware of it, but it's a very different approach than if you're able to trade, in the 24-hour session, essentially, right? So think about that. Like how would you posture yourself if, let's say, the SPY had returns of, like, including the dividend stuff, 400, almost $400, $396. What if the open to close was like minus $200, right? That would even be more significant than minus 10. I mean, basically minus 10 just says there's no performance that comes from open to close over the long sample. But what if it was like minus 200? Well, then you would even have a greater edge to, always short every time you got some premium during the day. You just bang it on, right? See, so it changes, right? So the statistics impact how you formulate your strategies, how you participate, but you always have to say what is out there that can run over that statistical framework, right? What can impact it? Just the same with seasonality. We have seasonality works 80% of the time over the long sample, but on any given event or any given day, we could have the greatest ideas for expiration Friday on the seasonality, And yet we might be, run over. It's possible, but it's only one day. It's only one event. It's only one part of everything that we get to do all the time. So again, open to close, you're going to focus on more reversals, more mean reversion, more noise, separate the inside days from the expanded trading range sessions. No different than how we were looking at 13-day trading range and then a subsequent potential for a break, which was going to break one way or the other at some point, right? We didn't, at some point you didn't know exactly which way to break. It was going to break one way or the other. So it had a catalyst that broke it to the upside. Now, it was different for the markets. For example, Q's didn't have a 13-day trading range. It only had a 5-day, and it didn't break the 5-day. Even with the catalyst on Friday, it did not break the 5-day at that point. But the diamonds did, the spiders did, and the Russell did, right? So that's enough arguments probably that the Q's say, me too, why I don't want to be left behind. So, but just remember, so just like that it becomes a different 2-day event here with the catalyst. That it's the same approach for that open to close noise trading, is that you have to respect the events and adjust and not fight it, not argue with it, right? And so if you're doing basket trading, long and short, there's an argument to weight the capital. When you have a lot of people watch the movie, they're just looking at all the symbols, trying to figure out something to do. Especially point and click traders are notorious for, well, what am I going to do today? Maybe I'll do something that I heard somebody talk about on the telly, or that looks good, looks like it's going up, or looks like it's breaking out, and so you get involved. That's a very different approach than if you already have positions on, say from the open, and you've got long and shorts balanced, so you're trying to be insulated to the market direction. And that's a great baseline. That's a great place to be, because it gives you a feedback loop. You get information from how the stocks are behaving. You can also look at the indexes and see how they're behaving. Now take that feedback loop and go, can I add weight to the direction that the open to close is moving in, especially if there's a catalyst? Can I add weight? Because when you add weight, it doesn't interfere with your objectives on the individual stocks. You're not trying to be very discretionary on, well, I think that one's done, or I think that, that's losing me money, so I'm going to cut it. You're not trying to be discretionary on that. You're just recognizing an opportunity to add weight. And you say, well, that doesn't seem like statistical trading. That doesn't seem like sort of mechanical trading. That doesn't seem like it's part of the process. Well, it is, because you're not here to build the perfect widget. You're here to make money. You're here to make money every day from the markets, right? So if that's one of the ways to do it, by adding some weight, then learn when the best opportunities are for that, right? And then the next thing goes to protecting profit on the individual stocks, or looking at what might be causing a loss. So I wrote this up in our write-up for the S&P 10 by 10 list there, and also for the NASDAQ list. For the NASDAQ, we had AMAT in there on Friday as a short. Well, the semiconductors, got lit up on Friday for sure, right? So I pointed out that one simple way to protect yourself is understand how you can have a reference security for everything that you're trading. There's something that relates better. It correlates better, whatever. So for AMAT, there's a lot of different semiconductors. But one of the simplest is just to use the semiconductor ETF, and there's more than one. But let's take SMH. SMH was a perfect hedge against the negative performance for you of AMAT. AMAT was on fire, right? And AMAT opened, pulled back, didn't quite fill the gap, and reversed and went stronger. SMH opened, pulled back, and filled the gap completely. So it was a bit of a lagger because it's got other components in it, so it's already statistically muted anyway. But SMH then proceeded to, move the same as AMAT. In fact, from open to close, had even better performance than AMAT. So, people started to pick up on that, right? So my point is that when you're in baskets, your attention always goes to the things that are benefiting you the most or harming you the most. And it's going to usually be just a couple stocks. So what can you do to offset the problem, or what can you do to protect the profit? So I'll leave it at that.
Yeah, that good points today. Well, does the rally have legs? Well, it sure does. We've tacked on like another 10, 12 handles since we started the show. A bunch of 1-stars on my sheet for daily resistance here. So upside target on the day would be 95.25. I don't quite think we'll get there, but good information today, Rob. As always, we're going to go out with the S&Ps up 51.50 at 39.67, trading off just those highs of the session. Everyone, good seeing you again this morning, and I'll be back with 3:30 at the close.